Hello and good morning. Welcome to the Greenstone webinar on ESG risks and opportunities for private equity firms. It's a pleasure to be here, taking part in the New York Climate Change Week, albeit from London, England, but hopefully I can meet some of you in person next year. Before we start, as we only have 30 minutes for this session, I should point out that there probably won't be much time for Q&A, but I would encourage you please to ask any questions you may have. Whatever we can't cover today, we'll look to issue an FAQ document to all attendees in due course. As we can see here, my name is Toby Robertson, and I'm the head of Investor Portal at Greenstone. I don't want to spend too much time talking about what's coming up, or indeed myself. Having seen the flatteringly large number of you that have kindly spared some of your time to join this webinar, I'm aware that many of you could no doubt teach me a thing or two, so I'll try to keep it on point. Beyond a quick background, we'll review the top 3 risks and opportunities that will, I hope, be food for thought. And then we'll have a quick look at what our award-winning ESG solution offers and some of the reasons why it's generating so much interest. Before we kick off then, a little background on Greenstone and who we are. Essentially, we're a provider of sustainability software, and we have been since 2007. We only have 3 products, so it's a relatively simple story. The first one is Enterprise, which enables corporates to evaluate their own sustainability in fantastic detail, and is used by many leading organizations around the world. It didn't take long actually for some customers using Enterprise to ask us to build a product that looks outside their scope of operations, and that's what really gave rise to our second product, Supplier Portal. And Supplier Portal enables corporates to evaluate sustainability, as you'd imagine, in their supply chains, and that is also now being used globally. The third product is Investor Portal, and that's our newest product, which is an ESG solution for private capital investors. It launched late last year, and I won't say more about that now. We'll see a glimpse of that a little bit later. So, ESG. I'm not here to define it, and most people here today will already recognize ESG as a glaring opportunity. But there are still plenty of people sitting on the fence, and hopefully what we explore today will convince some fence sitters that this really is a not be missed carpe diem moment. So on that note, let's get started. Importance and relevance. I'm sure you're all aware of how well served the public markets are in terms of ESG, certainly at least in terms of quantity, if not quality. At the same time, the private markets seem to have been left behind a bit, and to me at least that's strange, because it's the private companies that have the real capacity to drive meaningful change. Their percentage ownership means there's scope for open dialogue, and the tenure of their investment, which is typically about 5 years, means there's also scope for working together with their portfolio companies to identify areas of weakness, define KPIs, and make lasting improvements. There's little doubt that public markets are crowded with ESG data providers. Last time I looked, there were well over 150. most of which have their proprietary algorithms and methodologies and charge a lot of money for their service. Thankfully, relying on opaque third-party data with no correlation, which is what we see in the chart here, looking at data from FTSE and MSCI, this isn't an option for the private markets, and that's largely because such information isn't easily available. And the reason for this is that most of the third-party ESG data used in public investing is scraped from questionnaire-fatigued corporations. There simply isn't enough information to scrape on smaller companies, unlisted companies, SMEs, and that's a good thing because scraping has various limitations. So, for example, what we see here is a headline. This actually relates to a company called Isravision, which is a company that found itself on the wrong end of a typical scrape and challenge rating process early this year and successfully went to court to take issue. It's here because it's a landmark case, because scrape and challenge process is typically very sort of prevalent, and scrape and challenge, to sort of explain, is where a provider of ESG data scrapes data from all available sources and challenges the company to verify before publishing. As you can imagine, given the large number of different data providers, companies simply don't have time to respond to all such requests, and the result is that, as in this case, the proprietary score they produced based on the scraped information was published anyway. In this case, they got a D-. Isravision understandably felt aggrieved, and the courts agreed. Let's face it, I mean, using unverified and incomplete information from the internet to make an opinion is a dangerous business. We all know that. Anyway, at the risk of being sidetracked on this, if we look at it in terms of quantity in the public markets versus quality potentially in the private markets, it's not a bad thing that the private market has been left behind a little bit. And as I said, private capital is in a privileged position. It can do things that the public market players can really only dream about. Real connections, real progress, and this is the real opportunity that's literally in front of us today. What's encouraging, and I'm sure you've seen this chart before, is that more and more investors are already embracing this opportunity. Like here's us here at Greenstone. Many of you listening today will already be signatories of the PRI, and that's a clear sign of our shared belief that ESG is here to stay. As an aside, it's worth noting that the growth shown here isn't dissimilar to that of ESG in finance as a search term on Google and various other things. So there's every suggestion, that this is just the beginning, really. However, all that glitters is not gold, and if we break down the PRI signatories we saw on the previous chart by private equity interest, what we see is that 8% of all PE firms globally are signatories. That's not bad, but there's clearly a long way to go, and let's not forget that the PRI has been going for 14 years. More worryingly, if we drill down further, what we see is that the proportion of those 703 signatories that are actively using ESG across their portfolio companies falls away rather drastically. So we can see 304, less than half, are guided by an RI policy, and just 98 have an ESG or sustainability policy for over 90% of their portfolio companies. Now, there are many reasons why this might be the case. Capabilities, especially for smaller companies, resources, priorities, but I think particularly knowledge. When I talk of knowledge, I'm talking about the dizzying array of frameworks, guidance, initiatives, principles, regulations, standards, you name it. There are a lot out there, and this page could very easily be plastered with an alphabet soup of acronyms and logos. But here are 9 of the most common. And bear in mind also, this ignores EU taxonomy, science-based targets, net zero, and much more. So knowing what to do is complex, and that's true for the experts as well. Fortunately, there are signs of collaboration, if not consolidation. As many as you'll be aware, the PRI and WBCSD have recently agreed to partner on ESG data and corporate investor dialogue. So that's a good thing. Also in the past month, CDP, GRI, CDSB, IR, and SASB have issued a statement of intent to work together towards comprehensive reporting. Again, a good thing. These are all positive signs, but even in the best, most optimistic case scenario, progress will take time. Just last week, there was news that a large number of investors have pushed back on new ESG disclosure rules proposed by the EU on the basis that they were unfeasible, costly, and irrelevant. So it's a case of sort of one step forward, half a step back. And there is no silver bullet, not yet at least. And for now, I'm not holding my breath. And that brings us on to risks. So let's explore the top 3 risks concerning ESG in private equity. Drum roll. Okay, the biggest risk right now is to do nothing. For all parties, LPs, GPs, PCs, waiting for a one-size-fits-all regulation is a mistake. And for GPs in particular, where there are top-down and bottom-up considerations, it's especially important to get started. Effectively not doing so will impact both fundraising and performance. So for instance, if you can't maximize divestment values by proving ESG enhancement, your returns will suffer. Then, even if you do stay on the LP's radar, you'll fall short of their ESG investment criteria. And thereafter, it's a vicious cycle. Risk 2, commitment. Having lived in Asia for many years, this picture always makes me smile. It shows how the Rio and Shanghai underground systems grew or not between 1993 and 2013. So where risk 1 was about starting, risk 2 is about delivering. This second risk is all about having the right approach to think up and deliver a plan. So for us here today, it's about seeing ESG for the opportunity that it is and maximizing it. So if I was to ask you, if you were to map your ESG plans, how would they look? And how will they be when you look back on them in years to come in terms of what you've actually brought into reality? Importantly, while the growth of Shanghai's underground is astonishing and clearly very impressive, it's worth remembering that sustainability is a journey. It's a process, and it continuously develops. For us, it's not about the point specifically, it's about progress. We all have to start somewhere, and at Greenstone, we definitely prefer to encourage people to concentrate on the trend rather than the absolute score. Risk 3, spreadsheets. I know it's terribly unoriginal, but everyone uses spreadsheets, and 90% of spreadsheets contain errors, and they can be very expensive, as I think it was JP Morgan found out in 2013, where it cost them billions. I think the message here is that sticking with Excel, Word, PDF, emails, and all on different computers is risky and inefficient. Excel, it's great and incredibly useful, but it's not a database, and there's a lot of publicly available insight about that already. So the takeaway here is that Excel for ESG is absolutely not the way to go. Okay, that's enough of the potential downsides. Let's now turn our attention to the top 3 opportunities. Opportunity 1, be genuine. So no pretending, no pretense, definitely no greenwashing. Our experience at Greenstone shows us that the most successful GPs are basically just using common sense and getting on with their own thing. So they're doing what's right for them, for their PCs, and also for their LPs. They're definitely not waiting for regulation to magically appear, although I suppose if ever it did, their lives would just become much simpler. The message here is that if you can focus on what's material to you and your stakeholders in a collaborative, transparent way, which explains the reference to trust that we can see here, then success is all but guaranteed, and not just for you, but for creating a better world. Opportunity 2, be outstanding. As with anything in life, you can do something or you can do something well. To that end, rather than following or waiting to be told what to do, we're basically saying have your own say, make a difference, be part of the ongoing, evolving ESG conversation, create better companies. By getting involved and putting things into action, you will develop better processes and work more closely with your portfolio companies, and that has to be a positive thing from every perspective. So from feeling good about what you're doing to market recognition to bottom line returns. It's all round win. And opportunity 3, be commercial. This third opportunity is often overlooked, but ESG really shouldn't come at a cost. There are plenty of studies to show that ESG can be utilized to limit risk particularly, and also to improve returns. These studies tend to focus on performance or divestment valuations, but beyond those, if your ESG processes can shine brightly on an LP's radar, fundraising should be a lot simpler. To sort of summarize this point, I mean, at a performance level, maximizing sale prices with proof of ESG enhancement will boost fund returns. And at a fundraising level, if you can exceed the ever-increasing ESG requirements of LPs, you will increase your AUM, and this forms a virtuous circle. So there we have it, 3 risks, 3 opportunities. The question now is how to do something about these. And the answer is software, or part of the answer. Software is about much more than just moving away from Excel. Our purpose-built software provides a secure, streamlined, and frankly superior way to gather, manage, store, and analyze ESG data. So let's look at a few of the features that makes Investor Portal a better way to do business. First up, user permissions with granular access. This might not appear very special, but the point here is that you decide who sees what, not just internal teams, but also external teams. So if you're doing scoring externally, or if approvals or audit is done externally, and also, of course, LPs, they can all have very defined, limited access. Interestingly, when we launched Investor Portal at the end of last year, we thought that GPs would be thankful for the ability to provide LPs with restricted access. And we were rather surprised to hear that they wanted more reports instead and didn't want that at all. So we built them the reports, and that was all fine. Fast forward a few COVID-19 months, and suddenly transparency is the order of the day. And now everyone wants to provide granular access. It's been a fascinating turnaround. Beyond access, communication is obviously important. Until now, we've been told that dealing with ad hoc LP requests has been a bit of a headache for GPs. And what we can see here essentially makes that super easy. We provide WhatsApp style messaging, and that means that we can now not only dispense with a lot of scattered spreadsheets, but also documents and emails. So everything is stored securely and centrally, and you've got a complete searchable history of everything and all changes as well. Now, we know that pain points are shared across the investment chain, and so it's important to make sure that Investor Portal makes things easy for all parties, and that includes very much portfolio companies. So as a result, when completing a questionnaire, respondents have access to a comment section to provide supplementary information. They can see a glossary with definitions for any unfamiliar terms or acronyms, and I'm well aware that I've used rather a lot in this, as well as answering guidance to limit the need for queries going to and fro, and as shown here as well, past answers that can easily be copied across. So the goal here is to make responding as simple as possible. Dependent questions also sort of remain hidden until they're activated, so you're not scaring respondents with a vast array of irrelevant questions, and there are various other features too. Response rates aren't an issue in private capital, but it's still important to make everything as friction-free as we can. As with questionnaire scores, everything is treated as a version in Investor Portal, and that's to maintain integrity. So once created, risk matrices, like the one showing here, cannot be changed. This example is actually taken from the demo site, and what we can see is that in November 19, this company created a list of what they viewed then as the top 10 risks for their business for the year ahead. Unsurprisingly, cybersecurity is top of the list. But what's interesting is if we look down, I think it's about the seventh one, is plague. And given where we are, that's not a bad shout. So if we look at impact, the impact of plague was high, probability low, but here we are. And really where it gets interesting is when we look at the third column, mitigation. Now in this example, there's nothing actually written, but in real life, you would be going back and meeting with the company after 6 or maybe 12 months. And this would very obviously be a point of discussion. So this enables you to appraise how on the ball management are in terms of assessing potential risks and, more importantly, reviewing where applicable, how they did in terms of mitigation in reality. It's simple, but it's highly effective. Now, SDGs were never intended for investment purposes originally, but try finding an annual report without at least one SDG. Although they're extremely visual, which is, I guess, why they're everywhere, this slide isn't, in fact, about SDGs. It's really trying to show an example of our ability to tag questions against different frameworks. So here SDGs. In this case, what we can see is the relevance of the SDGs based on responses to tag questionnaires. The great thing here is that there's no additional work necessary. Once you've tagged it, the outputs are easy and they provide transparency. So in this example, we can see a rationale for why certain SDGs have been chosen, either for the portfolio or for a fund or for a specific company. Ultimately, Investor Portal provides total flexibility. And that's true for creating questionnaires, scoring questionnaires. So when it comes to scoring, there are actually 4 different types of scoring methodology. You can have manual, automated, scaled, and computational. I don't have enough time to go into them, but all of these sorts of things and more I'd be happy to explain another time. But effectively, Investor Portal was purpose-built to be useful, flexible, and scalable for all levels of users. In addition, as well as having as many questions, questionnaires, benchmarks, and so forth as you like, you can have an unlimited number of users, which avoids the standard problems associated with restricted user access. Okay, as a last word, I guess I'd just say that if your system, so whatever you're using at the moment, is either based on a spreadsheet, is a spreadsheet, or doesn't come with unlimited customer support for both you and for your PCs, I suggest you're making the wrong choice. Not only are all of our customer support team experts with the software, but they're also all experts in sustainability. And that applies not just to Investor Portal, but to our other products as well. And the other thing about Investor Portal is that we operate on a software as a service basis, and we treat each product as an ecosystem. So for our customers, if there's anything within the system that doesn't exist, we then work with them to fill any gaps. And when we build those and release them, which happens every 2 months, those are then shared across the ecosystem, so everyone benefits. And that's a very sort of rich way of working that benefits everyone. And I suppose we provide all of this experience and expertise ultimately for pretty much the price of a cup of coffee per portfolio company per day. So hopefully that represents great value. So looking at the clock, that's about all we have time for today. Sadly, I don't think there's going to be much time for Q&A, but please do send in any questions you might have, or let us know if you'd like more information. I think a copy of this will be shared, as I say, with all attendees, and we'll look to do the same with any questions. So yeah, I hope you've enjoyed today's webinar. Thank you again for your time, and enjoy the rest of New York Climate Week.